What's up, audit fans? Dr. Amanda White here with our next video in the series on Standards Explained. We're looking at ASA ISA570 about going concern. If we look here at the index, there's actually quite a lot in our requirements section and within our explanatory material. Now, I don't normally talk about explanatory material, but today I'm actually going to talk about a diagram in the back of the explanatory material that actually maps out the process of going concern. As always, we have our conformity statement that ISA and ASA570 say the same things. Of course, there are a number of paragraphs that contain AUS in the prefix that only apply to Australian firms. Now, ISA 570 requires the auditor to consider the appropriateness of management going concern assessments for 12 months from the date of the financial statement period. However, there's a slight wording change in Australia, which says 12 months from the date of the current report to the expected date of the next report. It's fairly similar, but there's a slight change. So let's dig into the actual standard. We know that from our definition, going concern is the assumption that they're going to continue into their operations for the foreseeable future, and we're only going to do something different if they intend to liquidate or cease operations. So sometimes companies may know they're going to close, or the assessment of their financial statements is so dire that it's fairly likely that they are going to close. Now, in that instance, they have to prepare special purpose financial reports, and they may not use the going concern basis. One of the common options here is something to use liquidation values. That's not actually specifically put into the standard, but it is a common practice. So whose responsibility is it to assess going concern at the client? That responsibility must lie with management. All right, so there's an explicit requirement for management to make a specific assessment. Now, the interesting thing here is that assessment is actually not recorded anywhere in the annual report. Instead, what we have is that we have a section usually where the management say that if they use historical cost, so they'll say they've prepared their financials in accordance with historical cost accounting, then we're actually going to make the assumption in that instance that they're going as a going concern. So there's not a specific paragraph that says, we think this company will be a going concern. I haven't found anything anywhere, but they say, we're going to use historical cost accounting. Well, that's implied that they're going to use going concern as the basis. Now, what do management have to do? Well, management's assessment of the ability to continue as a going concern involves making a judgment. And this is important at a particular point in time. So we can only make the judgment based on what information and facts we have at that particular point in time. That means that there's going to be uncertain future outcomes. So when we had the global financial crisis, at the time, most firms looked like they would be a going concern, and then a future event occurred that plunged the market into a recession, and that would change management's assessment, but they couldn't have known about that at the time that they did it. So they have to make that judgment based on information available at the time which the judgment was made. So there may be subsequent events that are inconsistent. That doesn't mean that they were wrong, doesn't mean that the auditor then becomes wrong, but we just need to be aware that there could be changes. So what are the responsibilities of the auditor? We have to get sufficient appropriate evidence. Remember, that comes out of ASA, ISA 500. This is still an evidence standard about whether management are using the going concern basis appropriately. So we're going to talk about something called material uncertainties, and I'm going to go through the flowchart to help us identify whether we've covered everything or not. So if we dig into the actual standard here, the objectives, again, the objectives in the previous section are pretty similar. Sufficient appropriate evidence, make a conclusion about whether there are any of these things called material uncertainties, and then to report in accordance with the auditing standard, which means that within our audit opinion, we're also going to need to consider our going concern assessment and putting a little paragraph in about whether we think the company or the entity will be a going concern. So where do we start in terms of our requirements? Well, the first thing is assessing risk. All right, so just like at the beginning of the audit, we have to perform a risk assessment under 315. At the planning stage, we need to consider, is this company a going concern? Now, why do we need to do it at the planning stage? Because if the company has some potential risk of not being a going concern, I need to keep that information in the back of my mind while I'm doing the audit and I'm doing the planning. So if there's a greater risk that the company may not have cash flow, or they may not be able to roll over their debt, I need to know this at the planning stage rather than at the end of the audit where I might run out of time to go back and do something else. If I go and I do my assessment, I actually talk about the assessment with management, right? And we say, has anything happened that might cast significant doubt on our ability to be a going concern? And then, what are management's plans to address them? So, our loan is going to expire, we need a new loan. Well, if you can't get a new loan, that might create a material uncertainty and some doubt. So what's management's plan? Oh, we're talking to a couple of other banks. We're looking at raising capital. And then when we're looking at that plan, we have to say, or we have to consider, what is the likelihood of success? So if you had a phone company, for example, and they're a new entrant to the phone market and they say, all right, we're making mobile phones and we're going to take 40% of the market share in the next 12 months to dig us out of some financial uncertainty, I'd say, I don't think that is potentially going to happen. If we've done the assessment, then we have to discuss it. If we haven't done the assessment, then I need to talk to management about going concern and then do my own work. So I have to be alert throughout the audit for evidence or conditions about going concern. And that's not just one person, that's every team member needs to consider the possibility of a risk of going concern. And that means for the audit team that communication and regular communication is going to be really, really important. Because if they're not communicating regularly about things that they find or things that they might see, someone might find something in one area which on its own might not seem significant or important, but combine that with information from someone else's part of the audit, and we might have some serious issues. So I have to do my risk assessment. Second step is evaluate management's assessment. So we look at management and say, well, have they done this the right way? So I actually go in and I evaluate management's assessment. Are they using all of the right information? If they are making assumptions about changes in the market or growth, are those assumptions valid? If they're making projections about their performance, we have to say, do they make sense? Do they seem reasonable and also achievable? Like I mentioned before, the new phone company that says, hey, yeah, I'm going to be able to have a whole new set of phones. I'm going to take 40% of the market share. That's going to be pretty hard in the Apple v. Samsung type environment. Now, what happens if I assess management's going concern and I think, ooh, I do have something to be concerned about? Well, when I've identified something, then I have to go get sufficient appropriate evidence to determine whether or not a material uncertainty exists. And so that's a term that's going to be really important, material uncertainty. So a material uncertainty is something that's going to cast significant doubt on the ability to remain a going concern. All right, so it could be anything. It could be you lose your chief research and development scientist, something that you make becomes illegal, if you receive a government subsidy and that disappears, then I have to consider, will that affect going concern, and Are there any mitigating factors? That is there anything that might try and minimize the impact of that concern? So what sort of things do I need to do? Well, I need to evaluate management's plan for the future. Again, these things of, does it seem reasonable? Does it seem achievable? Will it improve the situation and help the client get back on track? If there's a cash flow issue, then I have to see, well, if they're planning out or making assumptions, again, I mentioned the word assumptions earlier, about future events, if I'm making projections, how reliable is the data that I'm using and the model and the assumptions that I'm using? So I need to consider, if management do have a plan and if there is cash flow, does that all seem reasonable? And then consider, are there any additional facts? So this is, I guess, a little bit like evaluating whether there are any subsequent events or subsequent information that could help me understand what the client is planning and think about whether it's likely. The last thing we have to do is we have to get a written representation from management. So we ask them to write down their plan and the model so that we can go and audit it. And we also get them to agree that they've told us everything about the situation. So I do these additional procedures, and then I have to come to some sort of conclusion. So essentially, when I'm making a conclusion, I'm asking myself, will the client be a going concern for 12 months past the date of signing the audit report? Sometimes says reporting period, and that's usually 12 months. So I have to go and I have to decide, did I get sufficient appropriate audit evidence? And are there any of these material uncertainties to ensure whether the client will be a going concern? If there is a material uncertainty, I've looked at how much it could have an impact. I've looked at, have management made disclosures? So that disclosure is going to be in the notes to the accounts. And then I have to make a judgment call. Have they fairly presented the information? And we need to make sure that it's not misleading. Now, if we do have things that are material uncertainties, then we do need to make sure whether they've been disclosed properly and that it's clear and understandable about these material uncertainties, because this is really important for shareholders to know. Now, since it is important for shareholders to know, then I also need to consider, well, what are the implications for my audit report? If the going concern base is inappropriate, so we think the company is not going to survive, things are not looking good for this company, then we have to ask them, well, if management are still going to use going concern, I have to go with an adverse opinion. If the going concern assumption is appropriate, but there's a material uncertainty, so things are not so dire, but there is something on the horizon, then I want to make sure that what management are doing is that they've got a note that says, hey, here's some information. They've given detail about the events. And then what I will do is I will have a separate section where I say, here are my information as an auditor. All right. So this is an emphasis of matter paragraph that we will add to whatever audit opinion that we have. Now, what if management are not going to make an appropriate disclosure? Well, again, we have a disagreement with management, so we're going to go with an adverse or qualified opinion depending on whether the issue is pervasive or not. Then we have to go through and we have to communicate with those charged with governance. We talk to the board, we tell them about the events or conditions that are a material uncertainty, what management's planning to do, disclosures in the financial report, and what this means during the audit. Now, we're better off telling our client this earlier rather than later if we think there's a serious issue, just in case management decide they want to change any disclosures or look for alternative plans. Now, this is the diagram that comes in the appendix, and this is one of the best diagrams I've seen in an auditing standard because it actually gives us clear guidelines on exactly what to do. So remember, we start out with doing our risk assessment. Is there a material uncertainty? Yes. Then we go down and follow these options. If we find that there is a material uncertainty and the use of going concern assumption is appropriate, then we can follow that down from here all the way down to the different type of audit opinion. So this is really easy to follow for students and for auditors because of its yes/no options. It gives you the exact type of audit opinion that is required. And what's even better is that in each of these boxes we have specific paragraph references so that if you get stuck, you know where to go. So in an exam situation, I would always say to students, start with this diagram and then use the diagram to plot out where you want to go, and then check these specific paragraph references and the audit opinion. So start from here and work backwards, because this flow process is much easier to follow than actually reading the standard. So that's it for ASA 570. I want to thank you for listening in or watching the video. If you thought it was useful, I'd love it if you could give me a thumbs up. You can always catch me on social media. If you've got any questions, pop them in the comments to the video, and I will see you next time.